Remember when China was the biggest buyer of U.S. debt? Good times. Those days are fading fast. Japan now holds that title. China's been steadily selling off its U.S. Treasury stash. This has big implications for the global economy, but what does all this mean? Why should we care about who owns U.S. debt? Well, buckle up because we're about to delve into the wild world of international finance. It's more exciting than it sounds, we promise. Let's start with the basics. U.S. government debt, also known as U.S. Treasuries, is how America borrows money. Think of it as Uncle Sam asking for a loan. He offers up IOUs in the form of Treasury bills, notes, and bonds. These IOUs come with different maturity dates. They also promise to pay interest to whoever holds them. And let's just say Uncle Sam has been on a bit of a borrowing spree. The total U.S. national debt is now over $35 trillion. That's a lot of IOUs floating around. So, who are these generous lenders keeping America afloat? Well, it's a mix of countries, domestic investors, even you, through your retirement funds. But one thing's for sure, China's not as keen on lending as it used to be. For years, U.S. Treasuries have been the investment equivalent of comfort food, safe, reliable, and always there for you. But why are they so popular? First, they're considered extremely safe. The U.S. has never defaulted on its debt. Investors see them as a safe haven, especially during times of global uncertainty. Second, they're incredibly liquid. This means you can buy and sell them easily in the massive treasury market. It's like the stock market, but for government debt. Finally, the U.S. dollar reigns supreme as the world's reserve currency. This means most international transactions happen in dollars, so countries need to hold dollars. And U.S. Treasuries are a convenient way to do that. Remember the early 2000s? The dot-com bubble had just burst and China was entering its economic boom. They were exporting like crazy, especially to the U.S. This led to a massive trade surplus. China was swimming in U.S. dollars. What to do with all that green? Well, U.S. Treasuries seemed like a safe bet, so China went on a buying spree. Their holdings skyrocketed from a measly $70 billion in 2000 to over $1.3 trillion by 2013. They were America's biggest creditor, and they knew it. This dependence on U.S. debt gave China a certain amount of leverage over U.S. economic policy. But as they say, all good things must come to an end. The dragon shifts its horrid reasons behind China's sell-off. Fast forward to today, and China's love affair with U.S. Treasuries has cooled considerably. Once the largest foreign holder of U.S. debt, China has been gradually reducing its holdings over the past few years. This shift marks a significant change in the global financial landscape. They've been steadily selling off their holdings, which are now below $800 billion. This is a stark contrast to the peak of over $1.3 trillion in 2013. The sell-off has been methodical and deliberate, reflecting a broader strategy. So what's behind this change of heart? One word: diversification. China is no longer putting all its eggs in one basket. Instead, they are spreading their investments across a variety of assets and regions to mitigate risk and enhance returns. China's economic priorities have shifted. The focus is now on strengthening their domestic economy and reducing dependency on foreign assets. This shift is part of a broader strategy to ensure long-term economic stability and growth. They're investing heavily in their own ambitious Belt and Road Initiative, or BRI. This massive infrastructure project is designed to boost trade and stimulate economic growth across Asia, Europe, and Africa. This global infrastructure project aims to connect Asia, Europe, and Africa through a network of roads, railways, and ports. By doing so, China hopes to create new markets for its goods and services and strengthen its geopolitical influence. China is also looking to decrease its reliance on the U.S. dollar. By promoting the use of their own currency, the yuan, in international trade, they aim to reduce their exposure to the volatility of the U.S. financial system. They're promoting the use of their own currency, the yuan, and investing in other assets like gold. Gold in particular is seen as a safe haven asset that can provide stability in times of economic uncertainty. They're even teaming up with other emerging economies like Russia, India, Brazil, and South Africa, the BRICS nations, to create an alternative to the U.S.-dominated financial system. This collaboration aims to establish a more balanced and multipolar global financial order. A costly uncoupling, potential fallout of China's debt diet. So what happens when the world's second-largest economy starts dumping U.S. debt? This is not just a hypothetical scenario, it's a real possibility that could send shockwaves through the global financial system. It's not exactly a recipe for economic stability. The ramifications could be far-reaching and complex, affecting not just the U.S. and China, but economies around the world. First, it could push up U.S. Treasury yields. Higher yields might sound good for investors looking for better returns, but there's a catch. Think of it like this. Less demand for U.S. debt means the U.S. needs to offer higher interest rates to attract buyers. This isn't just a minor adjustment. It could have significant implications for the broader economy. This could make it more expensive for the U.S. government to borrow money, which in turn could lead to higher costs for everything from infrastructure projects to social programs. Imagine the ripple effects on public services and development projects, potentially impacting everything from infrastructure projects to social programs. The cost of borrowing could skyrocket, putting a strain on government budgets and limiting the scope of future investments. Second, a decline in demand for U.S. treasuries could weaken the U.S. dollar. A weaker dollar might seem like a boon for exporters, but it comes with its own set of challenges. This could make imports more expensive, potentially fueling inflation. Higher prices for goods and services could erode consumer purchasing power, leading to a slowdown in economic activity. Of course, a weaker dollar could also make U.S. exports more competitive, boosting sales abroad. However, this benefit might not be enough to offset the negative impacts, but that's a double-edged sword. While exporters might gain, consumers and businesses relying on imported goods would face higher costs. Finally, China's selling spree could create volatility in the global financial markets. The uncertainty could lead to a loss of confidence among investors. Investors might get spooked and start selling off their own U.S. Treasury holdings, exacerbating the situation. This could trigger a chain reaction of sell-offs and market instability, leading to a chain reaction. The interconnected nature of global markets means that instability in one area can quickly spread, causing widespread economic disruptions. A world on edge, debt and uncertainty in the global landscape. But here's the thing, China's U.S. debt sell-off isn't happening in a vacuum. The global economy is facing a perfect storm of challenges. Global debt has reached a record $324 trillion. That's more than 3 times the size of the entire global economy. Emerging markets, already struggling with high debt levels, are particularly vulnerable to rising interest rates and a strong U.S. dollar. And let's not forget that China itself is grappling with its own economic slowdown and a growing mountain of debt. It's a complex and interconnected mess. What happens in one corner of the global economy can have ripple effects across the globe. The Great Unknown, charting the uncertain future of U.S.-China finance. So, what does the future hold for U.S.-China financial relations? The honest answer is, nobody knows for sure. It's a delicate dance between two economic superpowers. Both countries are trying to navigate a rapidly changing world order. They're pursuing their own strategic interests while trying to avoid a catastrophic economic meltdown. The stakes are high. A full-blown trade war or a sudden collapse of the U.S. dollar could have devastating consequences for the global economy. It's a high-stakes game of poker, and neither side wants to blink first. Join the debate. What's next for the world's economic superpowers? So, there you have it. China's decision to reduce its U.S. debt holdings is more than just a financial transaction. It's a strategic move that could have far-reaching implications for the global economy. This decision is not made in isolation, but is part of a broader strategy to assert its influence on the world stage. It's a sign of a shifting global power dynamic. The balance of power is constantly evolving, and this move by China is a clear indication of its intentions to play a more dominant role. The global chessboard is being rearranged, and every move has significant consequences. It's a reminder that the world economy is a complex and interconnected system. Every action taken by a major player like China or the U.S. sends ripples across the globe. Trade routes, financial markets, and economic policies are all interlinked, creating a web of dependencies and opportunities. And it's a call to action for policymakers and citizens alike. We must stay informed and engaged, understanding that our collective actions can shape the future. Activists, economists, and everyday citizens all have a role to play in advocating for policies that promote stability and fairness. We need to start thinking about how to build a more stable and sustainable global financial system. This involves rethinking our current structures and finding innovative solutions to the challenges we face. Collaboration and forward thinking are essential in creating a resilient economy, one that's not overly reliant on any one country or currency. Diversification is key to reducing risk and ensuring that no single entity holds too much power. By spreading our investments and interests, we can create a more balanced and secure economic environment, one that works for everyone, not just the privileged few. Inclusivity and equity should be at the forefront of our economic policies. What do you think? How can we create a system that benefits all members of society, regardless of their background or status? How will China's actions shape the future of the global economy? This is a question that requires deep analysis and thoughtful discussion. The ripple effects of such decisions can be profound, influencing markets, trade relations, and geopolitical strategies. Let us know in the comments below. Your insights and opinions are valuable in this ongoing conversation. Engage with us and share your thoughts on how we can navigate these complex economic landscapes. This is a conversation that affects us all. The future of the global economy is in our hands, and together we can work towards a more equitable and prosperous world.